Hi, I'm Mark Reefer, and welcome to the Wise Wealth Market Commentary, where in 5 minutes I give you our latest market insights. December was eventful in the market, much like a year ago when the financial markets got a gift from the Federal Reserve in December of 23, because they made a major pivot away from raising interest rates, extending the market rally then and well into 2024. This year, however, the Fed made another surprise December announcement, but they said they would be less likely to cut rates in 2025. As a result, and as I record this on the last trading day of the month, the market, as measured by the S&P 500 index, is down about 2% for December. However, even with that modest pullback, 2024 was a very good year with 10 out of 12 positive months and a second consecutive year with returns of over 20%. So, can the market make it 3 positive years in a row? Well, history says it may be tough. Since 1947, the average return in the third year of a bull market of 11 past bull markets, that average return was about 2%, according to Stovall Research. What's more, all of those bull markets experienced a decline of 5% in the next 12 months, while 5 of the bull markets endured sell-offs between 10 and 20%, and even 3 saw declines of over 20%. So even though we expect more market volatility in 2025, today I'll give you 2 keys for the market to make it 3 good years in a row. And those 2 keys are corporate earnings and the budget deficit. First, corporate earnings. The markets are not cheap, so continued earnings growth is critical. Here are the facts. Wall Street analysts are expecting year-over-year growth rates over 13% for the first and second quarters of 2025, according to FactSet Research. But the S&P 500 is already trading at a whopping 25 times prior year's earnings, which is the highest valuation for the second year of a bull market since World War II, according to CFRA research. So corporate earnings will have to stay robust or stocks will decline simply because all the good news is already priced in. But there are 2 positive signs, interest rates and corporate guidance, that should help corporate earnings. First, interest rates. The investment climate can remain favorable in the coming year because the market loves a Goldilocks economy that is neither too hot nor too cold, where the Federal Reserve does not have to raise interest rates. So if inflation declines, the Fed will be our friend, and that's good news for stocks in the coming year. Also, corporate guidance. We're seeing continued positive guidance from many companies. Reports in November and December confirmed that the growth in artificial intelligence is not about to slow anytime soon. And since 70% of our economy is consumer-driven, we were encouraged by strong outlooks from Amazon, TJ Maxx, Costco, and Walmart in particular. So even though we don't expect the explosive growth in corporate earnings like we saw in 2024, we're hearing of solid growth across several key sectors of the economy. So what's the second big key? That's the U.S. budget deficit. Well, U.S. government spending is unsustainable, and the global marketplace is waiting to see what we will do about it the next few years. And as I reviewed last month, the national debt in the U.S. is over $36 trillion and counting. The government now spends $2 trillion more than we take in. That's the deficit. So interest costs on the debt are now over $1 trillion per year and 14% of the budget. And that's larger than Medicare, and it's also larger than the defense budget. So changes must happen in the next few years, or the global markets will push back by selling U.S. assets and, in turn, the U.S. dollar, only to buy them back when they think prices are cheap enough. So far, though, the market likes the Trump victory and the prospect of policies which favor lower taxes and interest rates that also foster economic growth while simultaneously, hopefully, reducing debts through tariffs and smaller government. We'll see how they execute on that. The good news is, though, based on the size of our economy, the U.S. is one of few countries blessed to have a shot at growing our way out of our deficit. And that's plan A for now. We did it after the financial crisis. Before COVID, remember, even with lower tax and capital gains rates, economic growth generated more tax revenues and the annual deficit shrank several years in a row. Furthermore, the last time the U.S. ran a budget surplus was 2000 after the internet boom. Although President Clinton at that time and also the Republican policymakers who had the majority, they like to take credit for that. It was actually economic innovation and the internet boom which generated enough tax revenues to run a surplus. So perhaps we have another such opportunity with the AI boom. So in summary, the economy and market remains in a sweet spot with moderately lower interest rates and taxes. Although the market is expensive, we don't think the odds favor a big sell-off because the investment climate remains favorable. However, we're watching closely for signs of continued growth in this economic cycle, and we will continue to monitor the progress of the reduction of the U.S. budget deficit. Well, thanks again for watching, and as always, for your patience, your confidence, and your trust. And we'll see you next time on the Wise Wealth Market Commentary.